You know, when gold makes a move like it's making right now, history has a way of screaming a warning at us. It's a signal that something big is on the horizon, something that has, time and again, brought empires to their knees. So let's listen to what history is trying to tell us.
So here's one of the great head-scratchers in finance today, a real counterintuitive puzzle. Gold, the ultimate anti-paper money asset, is being snapped up and stockpiled by the very people who run the printing presses. I mean, think about that. This isn't just a small trend, it's a massive coordinated pivot. So the real question is, why? What do they see coming that maybe we don't?
And if you look at the data, wow, it tells a really powerful story. For decades, U.S. government debt, treasuries, was the bedrock of the entire global financial system. But that foundation is cracking. You can see it right here. Central banks are dumping U.S. debt while they are steadily and quietly stacking physical gold. They are literally swapping paper promises for a hard asset. That is a huge statement.
Okay, this is absolutely crucial to get. Gold isn't just reacting to yesterday's inflation report. It has this uncanny ability to predict future policy. Just think back to mid-2019. Gold started this massive rally before COVID, before the unprecedented money printing of 2020. It was signaling what was coming. And with the central bankers themselves as the biggest buyers today, it's pretty logical to assume they're positioning for the next major policy shift.
And look, this isn't some new, crazy thing. In fact, when you pull back and look through the lens of history, you see this exact pattern play out over and over and over again. So let's jump in a time machine and go way back to the Roman Empire. Roman coins, right? They were valuable because they were packed with real silver. But as the empire got overextended, emperor after emperor found a sneaky way to pay their bills. They just reduced the amount of silver in each coin. You can see the slow-motion collapse right here. The currency became worth less and less, which of course means prices for everything went up. This was the start of a playbook that would be copied for centuries.
And here's the thing that never, ever changes. It's always the easy way out. It is always politically easier to just create more money out of thin air than it is to make the tough choices, like raising taxes or cutting spending. A government can promise the world to everyone and then just quietly pay for it by devaluing the money that's in your bank account. And the crazy part is, most people don't even notice what's happening until it's way too late.
Okay, for a much more recent and frankly terrifying example, just look at Germany's Weimar Republic back in the 1920s. When they fired up the printing presses to solve all their problems, the currency didn't just fall, it completely disintegrated. But if you price gold in those worthless paper marks, its value went into an absolute hockey stick explosion.
Now, I want you to really look at this comparison. On the left, you've got Weimar Germany. On the right, you've got the price of gold in US dollars today. Now, obviously, the scale isn't as extreme yet, but the shape of that curve, it's disturbingly similar. History is basically screaming at us that this is the visual pattern that comes right before a major and often very rapid loss of purchasing power.
All right, so that brings us to the big question. Why? Why is this historical pattern showing up again, right here, right now? What is the crisis that gold seems to be sniffing out?
See, to really get what's going on, you have to peel back the layers and look past the headlines. Because the truth, as it so often is hidden in plain sight. It's right there in the government's own budget numbers.
Okay, let's start with the big, scary number everyone talks about, the national debt. We're talking over $38 trillion. It's a number so huge, it's almost meaningless. But believe it or not, that's not even the real story.
Because here's the kicker. That number isn't just sitting there. It's accelerating. It's growing like a weed. Based on the current path, official projections show that the debt could blow past $60 trillion in less than a single decade. We're not talking about a temporary problem. This is structural.
But this is the number that really keeps people up at night. The real crisis is what we call unfunded liabilities. It's all the money the government has promised to pay out for things like Social Security and Medicare. The government's own budget office puts that number at a mind-blowing $120 trillion. There is no reality in which that can be paid for with taxes. It's just not possible.
So what's the bottom line here? It's pretty simple, actually. You can't borrow your way out of a debt crisis. You can only borrow your way deeper into one. And just like Rome and just like Weimar Germany, these promises will be paid for the only way they can be, through inflation, by debasing the currency.
By the way, if you're finding this analysis helpful, please take a second to hit like, share, and subscribe. That way you won't miss any of our future deep dives.
Okay, so this brings us full circle, right back to gold. Its big move up suggests it's anticipating not just the inflation itself, but the specific, clever mechanism that's going to be used to create it, a kind of secret weapon, if you will.
And just remember, gold is looking at what's about to happen, not what's in the rearview mirror. It's trying to get ahead of a major policy decision that's brewing behind the scenes right now.
The secret here is buried in a piece of financial plumbing that, honestly, almost nobody talks about. It's called the supplementary leverage ratio, or SLR. All you need to know is this. It's basically a rule that stops the big commercial banks from owning an unlimited amount of government debt.
So here's how it's going to go down. It's a 3-step playbook, and it's brilliant in a terrifying kind of way. Step 1, the Fed quietly removes that SLR rule. Step 2, suddenly the big banks are free to buy trillions of dollars in new government bonds to fund the deficit. Step 3, this expands the money supply just like quantitative easing, but, and this is the key, it's done through the banking system, not directly by the Fed. It's stealth QE, and I guarantee you 99% of the population will have no idea it's even happening.
And you might be thinking, is this just some crazy theory? Nope, not at all. They've already run a successful test drive. Back in 2020, the Fed temporarily lifted this exact rule. And guess what? The banks did exactly what they were supposed to do. They bought a flood of U.S. Treasuries. The only difference next time is that the change will probably be permanent.
So, what does all of this actually mean for you, for your portfolio, for the future? Let's bring it all home.
Think of gold as the scout that goes out ahead of the army. It's the canary in the coal mine for currency debasement. But it's almost never the last one to move. Historically, once gold makes its big move, other hard assets, real stuff, tend to follow. We're talking about things like base metals, energy, and all the industrial materials that you actually need to build things. They all start playing catch-up as the inflation story becomes more obvious to everyone else.
And that leaves us right here, with this one last big question. The echoes of Rome and Weimar Germany are getting awfully loud in our modern financial system. The path of debasing the currency to pay for debts is a very well-trodden one. So, as we stand at this fork in the road, are we just destined to repeat the same old mistakes? Or is there still time to choose a different path forward?